Good morning and welcome to the ADS Securities Markets Update. Beginning with the U.S. economic releases yesterday came in shockingly weaker despite the fact that estimates were very positive. And this includes the retail sales, the core retail sales, import prices and the NFIB Small Businesses Optimism Index. Beginning with the retail sales, it basically unexpectedly declined sharply by 0.3% in June while it had been anticipated to rise by 0.3%. Moreover, May's reading has been even revised lower toward 1%, down from 1.2%. The core retail sales also unexpectedly declined by 0.1% in June, while it was supposed to rise by 0.5%, at least of 0.5%. And moreover, May's reading has been even revised lower towards 0.8%, down from 1%. Most importantly, the retail sales, excluding the gas or autos and gas, basically also unexpectedly declined by 0.2%, while estimates were to rise by 0.4%, which is almost close to last month's reading. In addition to that, May's reading has been revised lower to 0.5 instead of 0.7%. The year-over-year import prices posted its 11th monthly decline in a row, which is basically not seen since 2009 during the crisis, when the import prices declined for 12 months in a row. Finally, the NFIB Small Businesses Optimism Index also declined, or unexpectedly declined again, toward 94.1 in June, down from 98.3 in May, while it had been anticipated also to rise or to advance again toward 98.5, and this is the lowest reading since March of 2014. The US dollar tumbled sharply against most of the major currencies yesterday following the economic releases, as September's rate hike hopes are basically fading or has also weakened already after today's figure, especially that the Q2 GDP downward revision is likely to appear anytime today or maybe this week. Therefore, traders decided to short the US dollar across the board and turn into the metals, and that's why gold basically trimmed its entire losses yesterday, turning green during the US session towards 11 or 11.59. In addition to that, or however, we cannot rule out September's rate hike or even a delay of the September's rate hike. Basically, we need more and more evidences needed in order to decide on our next outlook, but for the time being we will remain neutral. Today, the market awaits several significant economic releases and events in Europe and the US. But beginning with the Asian session today, the Chinese figure were positive as the GDP stood at 7%, while the initial estimate expected a dip lower towards 6.9%. In addition to that, the industrial production soared by the most in almost 3 months, rising by 6.8%, which basically reduces the likelihood of further intervention by the People's Bank of China anytime soon. In Europe today, the UK is expected to release its jobs report, which is likely to be very positive. In addition to that, is expected, or especially the wages are expected to go higher more than at 3%, and even greater indication of an immediate rate hike by the central bank or by the Bank of England in early 2016. In addition to that, or based on that, we're still estimating more and more rise or more and more gain in the British pound across the board, including the sterling against the US dollar. However, any short-term retracement should be also limited, especially if the wages come in with more and more gains above 3%. Therefore, we're still thinking for more upside target toward 1.57. In the U.S. session today, all eyes will turn again toward the Federal Chairwoman Janet Yellen testimony before the House Financial Services Committee, where it is expected to we might even hint for a delay for the September's rate hike for the time being, but the Bank of Canada at the same time is likely to cut the interest rate further by 25 basis points back toward 0.5, despite the fact that many analysts and commentators anticipate no change. However, the recent month-over-month GDP figures suggest that Canada is already in a recession after about more than 4 months of consecutive declines, and a month-over-month also GDP. In addition to that, the oil prices continue to decline again, which basically shows that there is no minimal risk of inflation for the time being, and given this is likely the bank is likely to act in advance. Therefore, this could be a bullish sign for dollar CAD again in the next few days, and this might, or if the bank cuts the rates today, the dollar CAD might continue to rise above 1.28 in the next couple of hours. The release of the UK jobs report today, coupled with the potential Bank of Canada rate cut today, could serve as a significant catalyst for what? For cable against, or for sterling against the Canadian dollar to rise above the two target in the coming hours. It's a very significant resistance area which should be watched very closely. Any rate cut by the Bank of Canada should grant a rally above $2 or $2 sterling. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. I'll see you again next week. Thank you for watching today, and happy Ramadan and also Eid Mubarak for all of you there. Thank you so much.